Welcome back to Alpha Uncovered, where we deep dive in the world of not just emerging managers, but different sources of alpha in the investment space. Very special guest today, Mr. Alvin Fan, the CIO, and that's the Chief Investment Officer over at Sun Hung Kai, or SHK Capital Partners. This is one of the more prominent family offices and asset managers here in Hong Kong. Alan, it's really good to see you.
It's great to be here, Alvin. Thank you for hosting this, and always many different topics that are very interesting for us to cover.
Yeah, I'm pretty excited about this chat, and maybe just as a pickup of your background. So you're running both a fund-to-fund and a multi-manager type of platform over at Sun Hung Kai. And so what I'm really excited about is this afternoon, I want to just sort of pick your brain about what you're seeing, both in the underlying managers, but also how we're going to navigate this sort of post-Trump tariff / US Sino trade war world that we're in. And I'm glad we're talking now because most of the guests that I have are either from the hedge fund space and managers themselves. So they're very siloed in how they look at particular market or asset class. And with you and me, I think we can talk more high level about allocation and where to go from here. So just maybe for our friends and our guests, you give us a 30-second blurb on what you do and how you do it.
Sure. So Sun Hung Kai & Co. is a listed company in Hong Kong. It's been in the business of traditional finance for decades, including mortgage finance, consumer credit, brokerage, et cetera. And over the years, it's built up a fair amount of capital on its balance sheet. And on behalf of the company, the investment team invests across the alternative space, including private equity, private credit, and hedge funds. So it is relatively broad in terms of those three segments, which I think is interesting as well, because we can really think about the opportunity set across these various areas within alternatives. For myself, I do focus on the hedge fund and long-only manager space. It's basically the same area I've been working in for over 20 years.
So does it mean you have another team that looks at like private equity and debt, et cetera?
That's correct. So we have a team that specializes in private equity, including direct investments, and in private credit as well. And that's a bit of the DNA of Sun Hung Kai & Co. It is a business that has been doing credit and loans for a very long time. So private credit is something we do as a core business.
Okay. So coming into this year, I actually didn't even ask you this last time, but how did your clients and how did your fund do coming into 2024? I mean, we're Asia-based right now, but obviously you're globally allocating. How were you positioning yourself, say, start 18 months back and then coming into first quarter 2024?
Yeah, sure. It's a good question. I probably have to step back a little further because being based in Hong Kong, Asia is clearly a very important region for us. And that was a large part of our allocation, call it 5 years ago. And over the past 3 to 4 years, we had been diversifying, globalizing, increasing allocations to the United States, to Europe, et cetera. And so it's a much more balanced global portfolio. And I think that was very helpful for 2024. There was certainly a lot of opportunities in all three of these regions. But for example, last year, US was very strong in terms of good risk-adjusted returns across a number of strategies. And then I think entering 2025, quite a different environment. So this is a time we're reassessing those allocations once again.
Yeah, okay. So let's talk about this last quarter and this sets the stage. So, I mean, you and I have been around for a few crashes, right? Like COVID was just the last one. Before that, we had GFC and
.com crash in 2000.
.com was the first one.
Yeah.
So one thing that I think everyone would agree, and just looking at the news, the feed this morning, it seems to be that there is a growing consensus that we are in a different paradigm, in a sense. But as of the time of this conversation, we're looking at a changing space, because even 2 weeks ago when we first started doing this pod, we're like, what are we going to talk about, right?
Yeah.
And we had a sort of an idea of how disruptive the tariffs were going to be, and this grand bargain that Trump and his administration is trying to play out, not just with China, but with the whole world. And so where we are today, China is clearly the target, but you have all of this ancillary risk that US is taking on by antagonizing both its allies, other trade partners, EM, in addition to China. And the idea that the administration has is to drive everyone to the table first create a tariff wall, so to speak, to encircle specifically China, and then force China into a negotiation table to reduce both tariff and non-tariff barriers in and out of the country. What is interesting is that, and not entirely unexpected, China's kind of pushed back and said, look, this is not how you negotiate or how we would agree to negotiate, and have tit-for-tat made escalations. And in more recent couple of days have somewhat de-escalated a bit. They've taken some of the tariffs down on key inputs for their industry, and so has US.
Yes.
So whether it's right or wrong, I don't really have a major view on, because I can see how the intuition of Trump seems to be in favor or in the best interest of the United States. So I don't think anyone can dispute that.
Correct.
They're facing $36 trillion of debt, refinancing another $4 to $5 trillion, trying to get everything under control, cleaning up the fiscal book, meanwhile trying to find other forms of revenue and enable themselves to continually, service the debt and print more money, right? It's a lot.
It is.
So what's your view currently of where we are with this battle? And then we'll talk about the implications for us as allocators afterwards.
Yeah, I think that's a really good summary, a very good assessment of the current situation. And I think what's different is how the marketplace has assessed the actions and also the level and intensity of those actions. If we go back to the time when he was elected, there was a view that he was going to do, as you described, in perhaps a measured way that would be maybe not so negative for the economy. Perhaps it would be targeted. We would have some negotiations to try to balance trade deficits where at least the deficit could be narrowed to some degree. But what we have clearly seen is that it's much larger in scale, much more demanding in scale, and I think that's what has surprised the markets, as we can see now. So I think that is clearly, in our view, and I think the market's view, a new paradigm. The question now is, how long will this paradigm last? Is it a shorter term phenomenon that can be solved and resolved relatively soon? Or is this much longer, more far reaching? Do we really have risks of recession that could be coming into the global economy, maybe in the summer or fall, et cetera? All of these new question marks are clearly creating a lot of uncertainty, but also defining and redefining what this paradigm is. As we can see, it's changing week by week.
Getting a bit into the nuances, when I think of new paradigm, when I look at even COVID or GFC, there wasn't a moment of hesitation in my mind anyway that this is a great opportunity to buy the dip, especially for US equities. But this time, I'm sensing trepidation where, okay, there might be like a short-term pickup as there was in the last week. Market's actually back up 6 to 8% since last month. So we've recovered quite a bit. But at the same time, there is a lot of de-risking from US. So the three major sort of incidents in the last 10 days have been bond rates spiking on the 10-year, bond auctions on the 5-year a few days ago, pretty weak. Now, rates have come back down from high 4s to 4.2, 4.3, which is great. But that was the type of behavior nobody really expected during a market crash. And then you had DXY, cliff, pretty severely below the support line trend over the last multi-year support line. So what I think everybody is nervous about is that, yes, there's an arguable, as in a good reason for why, say, for example, rates spiked that day. And I believe it was the basis trade, right? First, I want to talk about the basis trade. And I was looking at other newsletters, including yours, which mentions the spike in the bond yields. From my understanding, how do you understand that unwinding of the basis trade?
Yeah, sure. Let me answer that. But I think you've touched on two very important points. One is the nature of this paradigm and comparing it to some of the past paradigms. And I think that's an important point to cover, because if we contrast it to 2022 and 2008, there was a bit of a spiraling situation that was a bit out of control. In 2008, we had systemic deleveraging, the subprime crisis, et cetera, lack of clarity of how bad things were. In 2022, there was clear inflation. The Fed had a very strong path to hike rates, and it looked like there's no way they could reverse that anytime soon, which turned out to be the case. And that was a very long pressure on risk assets during those periods. Here, this one's a bit different because, as some have said, a lot of this is self-induced. And that's why we're seeing this back and forth that have changed the markets in a very short period of time, because while a lot of the negative news was put on in a short period of time, some of it could be taken off in a short period of time.
Right.
And we could argue that some of the damage is done. You can't take it all
This is
off.
just one data point, for example, right?
Exactly.
Yeah.
But this is why this paradigm is a bit different, because there's a bit more control to it compared to the past. And that's also what makes this a challenging period for managers to navigate through as well.
Right. So for you, in your allocator hat, are you looking at this as a short-term blip? And is the jury out on whether it is a paradigm shift?
It is, I would characterize it, this paradigm is certainly one of high uncertainty, very difficult to predict exactly what's going to happen in a short or medium term, and even the longer term is a bit more uncertain as well. But it's the nature of that path which will probably be a bit different than the others. Certainly we'll see high volatility. Some people are calling this recent reprieve a bear market rally. It looks a bit like some of the bear market rallies we've seen in past bear markets, but it's also hard to characterize in that sense because the nature of it is a bit different.
Okay, so what are you tracking then for you to get more direction?
I think it's really difficult. I think assessing the situation and understanding it may be difficult to have a direction for some period may be one outcome in terms of how to look at it, how to allocate to managers, et cetera. And sometimes if it's too difficult to call, maybe it's better not to call.
Yeah, yeah. I mean, U.S. has historically had a very strong U.S. dollar policy, which is what they called, it's a U.S. dollar strength policy. And then the incentive for lower rates is obvious because they need to refinance so much debt. So when rates pumped, it started off as a rumor and seems to be consensus now is that that was the unwinding of a basis trade out of Japan.
Yeah.
Because Japanese institutions were unwinding leverage positions where the underlying collateral was U.S. Treasury. And that caused a $20 billion pressure on the markets.
Yeah.
What's your reaction to that? And
it's a great question, and it's really worthwhile to talk about the bond markets. It's obviously a clear focus. It's a clear indicator of what's happening in the markets. And one thing my team does, which I think has been quite helpful for us, is that we track the views of numerous well-known, highly experienced managers which make market forecasts. They could be macro managers, they could be equity-oriented managers. They're usually very well resourced, and having a sense of where the market is going is an important part of their business. What's fascinating is there's been a lot of prognostications about various markets, bond markets, equity markets, and it's worthwhile to look at what's happened to the Treasury market. It has been as low as 3.6% last September. It went as high as 4.8% in January. It fell to 3.95% before going back up to 4.5%. All of this within, call it a 7-month period.
Yeah.
And that's very, very short for tremendous whipsaw volatility. I guess my point to say is the bond market really doesn't know. It looks very schizophrenic in terms of trying to indicate what is happening.
Has it always been this volatile? I don't have a recollection. I don't remember bond markets to be this volatile in a period of 9 months to a year like this.
You're absolutely right. And what's interesting is equity managers, many times they will talk in deference to the bond market, calling it the smart money, because there's perhaps less retail participation, et cetera. And they look to the bond market as a guide for inflation, for recession risk, et cetera. But if we look at how this has traded, it by no means has been any reliable indicator. So I think that's an important point, that the bond market, I think, historically has been one that many look to for guidance, but we can see in this recent trading, the bond market itself does not really know.
So my takeaway from that is that bond market doesn't know, but one thing's for certain is that the bond market is nervous. And number two is...
This week, but 3 weeks ago, it was a flight to quality rally.
Right, it was a flight to quality rally. But what I'm saying is that the sensitivity of the bond market seems to be much higher in the last year than it has ever been.
Absolutely.
And that sensitivity, my takeaway then is what happened in the last week is just one data point over actually a whole year, if not longer. and it's symptomatic of something more systemic is what I'm taking away from this.
I think that's a fair point. And we can examine one segment of the hedge fund world, which is the trend followers, the CTA systemic trend followers. This has been one of the worst periods for them in a very long time. And we can see that in the bond market. We can also see it in the currency markets and in the equity markets as well, that this type of high-speed reversals, this inability to have some clarity in terms of the direction of assets is making it very difficult for this particular asset class.
Got it. Last night, or was it yesterday, there was this big letter that Bridgewater came out with and Ray Dalio came out with. And I have the printout here, and it was pretty vicious in its bearishness over not just U.S. equities, but just U.S. in general. Although it came with recommendations on how Dalio himself feels that it can be fixed, called this beautiful unwinding, so to speak.
Yes.
But I want to get your hot take on a couple of points here. So one of the summarizing paragraphs, he says, today we see three interrelated dynamics at the core of this new reality. Number one, a new geopolitical and macroeconomic paradigm. Two, an urgent threat to investment portfolios from this paradigm shift. And three, a once-in-a-generation technological disruption. So why don't we start with the first one, new geopolitical and macroeconomic paradigm. The geopolitics, are they different enough that we need to be worried? That's kind of where I want to start with.
Wow. It's a very broad question. I mean, clearly it's having so much impact in terms of international relations, in terms of global markets as well. I think for the first time in a very long history, we're getting a reordering of how major countries are interacting with one another. And there's so much that is tied in with the international relations as it relates to the global economy, trade just being one of them, the utilization of currencies, reserves, what should sovereigns hold as reserves, et cetera, has so much implications for commodities such as gold, for example, and other fiat currencies, not to mention risk premia for holding equities as well. So the answer, in my opinion, is yes. This is certainly pretty material in terms of its impact for global markets.
The EM space, I think this is almost like a fantastic opportunity for EM in a way, because it used to be that allocators would not put too much focus on EM simply because the risk premium the spread was just too wide. But then now you have a year where even US Treasuries is trading like EM debt. Is pricing and volatility is like EM debt. And so now there is an interesting narrative where, well, if you're going to take that risk, why not get paid for it?
Yeah. I just came back from London last month, and in fact, we had spoken to several emerging markets debt specialists based there, and they're coming off of a very fantastic period. They generated north of 35, 40% last year in terms of returns. This year has been pretty strong for them as well. So to your point, this has been a very favorable environment. I think coming off of 2022, where interest rates were just so high and so prohibitive for so many emerging markets sovereigns, and now that that is normalized a bit, it creates an opportunity to differentiate, go long and short various countries. For example, the opportunity set in Argentina relative to other emerging markets. For specialists who really understand these economies and opportunities, it has been quite a good opportunity for them.
Yeah, I agree. I think Vietnam had a fantastic year last year out here in Asia as well. I mean, it had a tough quarter, obviously, because of tariffs, but on the ground, there are a lot of reasons for ASEAN venture markets to do extremely well. But developed EMs like Europe, if the pump in the euro last week was any indication, capital flows, I think that could be a great destination for rebalancing. And that kind of makes me realize a lot of the conversations I had with other allocators, there's a lot of talk of rebalancing.
Yeah.
And like when I say rebalancing, I don't mean like a quarter to quarter, let's shift, let's add a little bit here. They're literally reassessing current partnerships with managers and redeeming and looking at, okay, where do we want to establish our portfolio tomorrow, right? And it's not like from one US equity manager long short to another stat arb manager. We're looking at de-risking from US and coming out to Asia. And that was a conversation before this massive tariff war started. So one conversation I had 2 weeks ago, the allocator was saying, you know what, we were thinking about coming to Asia already. We're thinking about going to Europe as well. And we've been underweight for a while. China did surprisingly well last year, might be topping up a little bit, but they want to see what else there is in the region. And US is just Mag 7 priced to perfection. Even if it's not systematic, we need to take some chips off the table.
Yeah.
Right.
Yeah.
Hearing that, are you in line with that thinking, or?
Certainly, there's something to think about in terms of geographical allocations. One point on the emerging markets opportunity, and this is something we have to think about a lot for our investments as well as our client assets, is what is the trade-off between the return opportunity versus liquidity? So in that example I described, there's a very good opportunity, or there has been a good opportunity in emerging markets credit, for example, but that liquidity is lower than the major developed markets. You can see that in the redemption terms of these managers. They're much longer. They have quarterly investor gates, et cetera. So I think those are some of the critical or the important factors to bear in mind when thinking about moving down that liquidity curve, because one could be making an allocation to an area or segment that is performing very well, but if liquidity is not as good, when it comes time to change their minds, then that will influence that later on.
Not just the debt market, the equity markets, right?
Yes,
Well, one of the reasons
well.
why we don't have as much allocated to Southeast Asia is because the capital markets are just not deep enough, right?
Exactly.
And whatever is deep enough to move the needle on our books,
Yeah.
right, are the top 5 names in any one index.
Precisely, and that's also the same case for credit,
Yeah.
for less liquid convertibles as well, which have been quite a good segment to have been in for the past several years, including U.S. convertible arbitrage, et cetera. I think that will continue to be interesting, but I just think that is something for allocators to bear in mind. But to answer your question, as I mentioned earlier, we had made allocation away from Asia to diversify further into the U.S., et cetera, over the past several years. We'll most likely see a bit of a reversal of that going forward. And it's less about trying to call or determine where the markets will be, because I think that's very difficult to do. It's more just assessing the risk-adjusted returns. Are the returns one is receiving favorable relative to the risk, the volatility, the potential risks and drawdowns, et cetera, in that environment? And that we can observe right now. We can see volatility is much higher in the US. So we've been seeing some very good opportunities in Europe. I think that's been very favorable year to date for us, both on the equity market neutral and on the equity long short side. And Asia has been favorable as well.
Let me give you the second part of that conversation. And I asked them, they said, what if US markets really start steepening further, where a lot of these names, even outside of the Mag 7, start to become really attractive? US does start to clean up its books, its credit rating improves, bond market stabilizes. Would you then shift your allocation to, diversifying away from the US and now looking at US as an undervalued play, or at least as a recovery play?
Yeah, for us, we are really selecting managers that we think can invest and navigate through that period the best. Certainly valuations is one important factor, but also the nature of those markets. How are those markets behaving, which can enable them to do what they are doing best? If they're fundamental, deep research managers, they will be able to take advantage of these opportunities both on the long and the short side. But if there's so much volatility, as we've seen for the past 2 months, it just makes it very difficult for them to execute that strategy.
Yeah.
And there's another type of managers that are tactical, that can trade, can assess the situation, et cetera. They are arguably better suited for a more volatile period. But even when they get surprised, like in the month of March, where some of these markets moved far more severely than many anticipated, it can be difficult for them as well. So I describe it for these types of managers, the health of the capital market, the relative calmness of the market. Certainly some volatility is good, but if it's too much, then it just becomes very difficult for, what I would call high quality managers to navigate that period.
I agree. A lot of them have been, even in the previous paradigm, we saw a similar shift when we went from low interest rates to high interest rates in the last, 3-4 years. A lot of managers suffered, at least on the fundamental side. it gave some of the bottom-up managers the opportunity to prove their worth here in Asia. But in the US, again, it was really just the Mag 7.
Yeah.
And that's not really a fundamental long bias or a bottom-up approach. That's really just, accelerated beta in a way.
Yeah.
I was thinking back to your point about tactical as well. Those who have great experience, I was thinking about the quant managers here in Asia and even the US, a lot of them blew up in the last regime change shift from low interest rate to high interest rate, right? So it's hard to say how many of them are well equipped or their strategies are well equipped. Factors that were allowing them to profit before and spreads or correlations that were allowing them to profit before didn't work so well in the last 2 to 3 years. As we shift into this next phase, again, we may see that rotation weed out a lot of weaker hands.
Yeah. Just to point on that, one of our notable managers, probably the top performing manager last year, was focused on the small cap space. So outside of these Mag 7 securities. And that has been a very mixed environment. Small caps as a whole, I should say, have experienced some strong surges, but also some very violent sell-offs. In fact, when the markets sell off, the small caps as a whole can really drop very quickly and very precipitously. So ideally have a manager that can do both the longs and the short, can trade, and navigate through this period,
That's a tall order.
Exactly.
It's an art, right? Shorting is an art. Finding really good short alpha anywhere is tough. I think it's a little bit easier in the US because it's just more developed.
It is more developed. Its capability of getting borrow, et cetera, on a broader universe of names, really doing the research on these names. And I think one notable piece of information is that the mega multipods will generally not traffic in this area because it's just too small and too illiquid for them. So managers such as the one we're invested with, they hard close their fund at less than $300 million.
Wow.
So they keep themselves very small because they know that they need to do that in order to effectively go short and long.
These are capacity-constrained strategies.
Capacity-constrained strategies.
Right. Large institutions won't touch these guys because they cap out so fast. But they're perfect for mid-size and smaller multifamily offices like us, right?
Exactly. So that's really a nice niche for people like ourselves. People like our firm, we can allocate anywhere from $5 to $30 million, and that's a good size allocation for ourselves and some of our clients that want to access it as well.
Hey, I wanted to ask you this. I know I'm pivoting a bit. Private credit, what's your take on, I'm thinking about the last 2 years. Almost half of the conferences I've been to, we're talking about private credit, Asia and emerging Europe to an extent. Is there still a thesis for that now? And is it stronger now for Asia? And the reason why I bring this up is one of the challenges that Western investors had with Asian private credit was that the covenants were not really well proven or strong enough. A lot of the structural issues and trade imbalances may also play into potential defaults as well. And just counterparty risk, generally, they're not too comfortable. But from a fundamental level, there's a very strong case for Asian private credit. What's your take on that space, and is that worth looking at now?
Oh, absolutely. We are, as I mentioned, Sun Hung Kai is a sort of a core business for us that we do directly and participate in origination and investing in the private credit space. I would mention broadly, from a perhaps more systemic viewpoint, it's been a very popular space, and I'm not sure for the right reasons. It's been a space where many large allocators have gravitated to because it provides this steady stream of income with apparently no or low volatility. And the reason for that is it's private. So there's no need to mark these assets to market at any given time. So therefore, it appears to have these very steady, high quality risk-adjusted returns, which may not reflect a deteriorating credit situation in the underlying. We've been in a very benign credit environment in the US and most parts of Europe for quite some time now. So this has been very favorable for that space. But if we enter a more difficult period, for example, if we enter a more difficult period now or later in the year, there could be a lot of latent risks in this space. So that's a space it's more challenging to allocate with someone doing that unless one does all of the work and checks all of the line items themselves. And I think that's an important part of the process. It's something we do when we invest with managers. It's one thing that can be done with a solid long-short manager with 200 positions, but a private credit manager, perhaps with thousands of line items, it's just very cumbersome.
I bring it up because the returns are so attractive. Like we're talking about private, very institutionalized private credit funds here, can generate, mid double digit,
Yes. Yes.
right? Gross 16, net 13, net, 12 or so. It's very attractive. And if you think about it from a hurdle rate perspective where, risk-free is what, like 5.5%, rough, let's just call it 5.
Yes.
That's a high hurdle rate for equity fund managers.
Yeah.
Credit, obviously, but for private credit managers, if you can do triple that without leverage.
That's exactly right. So I guess my original comment was more broad on a global basis, but coming to the Asia space, which is the area that we focus on, looking for these opportunities on a single standalone basis, perhaps building a portfolio of these opportunities, it is perhaps I could describe stronger on a risk-adjusted basis we're seeing here in Asia, because Asia has sort of worked through a number of challenging situations over the past few years and has come out of it in certain areas. So in that sense, the environment for certain countries and regions is actually quite favorable. And in fact, we are seeing these returns in the double digits, call it in the teens, 15 to 20% type of returns, 2 to 4 year type of investment horizons, with what we consider to be quite stable assets. You see pseudo guarantees from sovereign investors, from other high quality institutions, et cetera. So when the team can structure that, there's some very interesting risk adjusted returns that we're seeing here in Asia.